Getting qualified for a home loan is not as simple as some people may think. To start, lenders have guidelines as to what they consider qualifying income, but there are some incomes that aren't automatically considered in your income level or have certain guidelines as to when or what aspects of the income can be considered. Examples of unusual types of income include being self-employed or owning your own business. If you own your own business or are self-employed, you have to provide documentation that you've been self-employed for a minimum of 2 years. If you're working off a commission or bonus basis as a substantial part of your income, this will also qualify as an unusual type of income. In this case, the lender usually wants more than just pay stubs or taxes from the previous year. When you have a job that pays commission or utilizes bonus pay as a part of your total income, you will have to provide 2 years' worth of information providing your income, which includes the commission and/or any bonuses you received. Your bills or debt are automatically held against you because obviously this depletes your income level each month. Basically, the debts which count against you will be credit cards, car loans, personal loans, student loans, and any installment type of loan. But some bills don't count against you when you're applying for a home loan. This includes bills for utilities, insurance, and general personal expenses you encounter on a monthly or weekly basis. Loans are also dependent on your debt-to-income ratio. Lenders want to know your front-end ratio, which is basically your gross monthly income before taxes and deductions divided by your home mortgage payment. Mortgage payment will include everything involved with the payment of your loan and payment of your house, including taxes, principal, and interest. What the lender is looking for is a ratio of less than 45% of your debt-to-income ratio and less than 35% for the housing ratio. Your employment history is another important factor for a lender to consider. Seeing a consistent and steady work pattern assures the lender that you will most likely be able to continue to provide an income and be able to make mortgage payments. Naturally, the longer you have worked in one place, the better, but a record of constant employment is nearly as good. Generally speaking, they want to see that you've worked at one place for a minimum of 2 years. What they don't want to see is a recent change in jobs. If you have an established and solid employment history, it is definitely a big help and positive attribute to obtaining approval for your loan. If you're planning a job move, wait until you've obtained your loan and the closing is done, just to be on the safe side. Your assets are also a big factor when applying for a mortgage. Lenders like to see that you've had the ability and the discipline to constantly save not only for a down payment on a home, but to have financial reserves should something happen to disrupt your income. Most lenders like to see that you have at least a 30-day or more reserve cash amount available in case of an emergency so that you can make your mortgage payment. Lenders are particular about providing a bank history to prove that you've maintained that balance for at least 30 days and will question any large deposits suddenly made in the account. A sudden large deposit sends up a red flag to most lenders. The reason for questioning sudden large deposits is to avoid you from borrowing money to pad your account so it looks good when lenders are checking your account. If you are receiving gifts from relatives to help you purchase your home, there are often very strict requirements on how to document these gifts and how much you can receive. As part of your savings or assets, the lenders will also include any retirement accounts that you have, but your retirement accounts are automatically reduced by approximately 30% of your vested rights amount. As they are considered assets, they will play a role as part of your reserves because most retirement accounts allow for hardship funding to be applied to a mortgage payment should you be facing a financial hardship due to a job loss, health issue, or any other reason. While each of these factors alone can help to make or break the lender's decision to approve your loan, most lenders will take all of these factors into consideration to make their decision. In some cases, you may be asked by the lender to provide a written statement to explain certain things if there are any particular red flags, like large deposits in your bank account, or if there are any questions concerning your employment. Don't let any one particular area worry you too much, as it's often the combination of each factor that helps the lender make their final decision. In the end, even the biggest of banks is run by humans, so the human factor can apply and possibly help you get your loan.